The stock market is currently closed, meaning we are looking at the final official data from the most recent trading session. Microsoft closed on Friday, May 29, 2026, at exactly $450.24 per share, marking a massive surge of 5.45% on the day. This explosive daily move was backed by an enormous spike in trading volume, with 79.6 million shares changing hands, which is more than double the company's recent three-month average of around 34.5 million shares. For a mega-cap giant of this size, a 5% single-day upward swing usually requires a massive fundamental catalyst, and that is exactly what happened here, as institutional cash poured back into the tech giant. While the broader market narrative over the past 6 months focused heavily on the tech sector pulling back, with Microsoft shares down roughly 15% from their previous all-time highs, this recent price spike shattered that negative momentum. The sudden surge has caught many retail traders flat-footed, especially those using basic self-investing techniques or hanging out on standard investing sites trying to time the bottom. The core driver behind this massive institutional volume was Microsoft's official disclosure that its commercial cloud business has hit a $37 billion annual revenue run rate, specifically tied to intelligence features, proving that artificial intelligence is no longer just a costly laboratory experiment, but a massive realized line item on their income statement. While the broader market narrative over the past 6 months focused heavily on the tech sector pulling back, with Microsoft shares down roughly 15% from their previous all-time highs, this recent price spike shattered that negative momentum. The sudden surge has caught many retail traders flat-footed, especially those using basic self-investing techniques or hanging out on standard investing sites trying to time the bottom. The core driver behind this massive institutional volume was Microsoft's official disclosure that its commercial cloud business has hit a $37 billion annual revenue run rate, specifically tied to intelligence features, proving that artificial intelligence is no longer just a costly laboratory experiment, but a massive realized line item on their income statement. The dominant expectation surrounding Microsoft over the past 2 quarters has been one of growing anxiety regarding profit margins. Everyday investors scanning online investing forums or checking their portfolios on the Robinhood app were starting to believe that tech giants were spending tens of billions on specialized silicon chips without a clear path to generating sustainable returns. The market reality delivered a massive shock to that thesis when Microsoft revealed that its Copilot user base has officially crossed the 20 million paid seat threshold, expanding at a massive 250% clip year over year. Instead of experiencing margin compression from running these heavy computational workloads, the company is demonstrating real pricing power and high adoption rates among large enterprise clients. This creates a fascinating dynamic when you compare the public perception of the tech sector against the actual balance sheets. People look at volatile assets like Tesla stock or individual high-flying names and assume that mega-cap tech has become too speculative to hold in a standard individual brokerage account. Yet when you look at the raw data, institutional wealth managers are treating Microsoft as a defensive cash flow fortress. Billionaire investors like Bill Ackman have reportedly been aggressively building massive stakes during the recent market pullback, signaling to the broader investment community that the company's valuation had fallen to incredibly attractive levels relative to its long-term growth trajectory. Think about how this contrasts with standard online investment advice that pushes people towards hands-off choices like Schwab Intelligent Portfolios or a standard automated intelligent portfolio. While those passive systems are great for broad diversification, they often miss the massive structural shifts that occur when an enterprise software giant successfully rewrites its entire monetization strategy. Microsoft is actively transitioning its clients away from flat per-seat licensing agreements and moving them towards dynamic, usage-based consumption models. This means that as corporations integrate these advanced digital tools into their daily operations, Microsoft's revenue scales automatically based on how much the software is actually utilized, creating a compounding growth loop that traditional subscription models simply cannot match. If you are managing your own capital through a Fidelity brokerage account or tracking movements on the Interactive Brokers platform, you have likely noticed that the gap between the top-tier tech firms and the rest of the market is widening. While peers like Apple stock continue to deal with hardware saturation cycles and hardware supply chains, Microsoft is operating in an environment where its software infrastructure is effectively mandatory for modern business operations. The recent launch of their new enterprise software suites and the upcoming commercial pricing updates scheduled for July 1, 2026 provide clear visibility into their near-term revenue pipelines, giving big banks and hedge funds the confidence to buy millions of shares in a single afternoon. Let us look closely at the trading mechanics that drove this recent session. The stock opened at 432.55, which was already an upward gap from the previous day, and spent the entire session climbing steadily before tapping an intraday high of 450.33 right before the closing bell. This type of price action suggests relentless accumulation by institutional desks rather than standard retail speculation. When you see 90 million shares trade on a day with no macro interest rate decisions, it means big pension funds, capital managers, and creators of massive Fidelity ETFs or Fidelity mutual funds are rebalancing their portfolios to overweight this specific name. They are pulling capital out of weaker sectors and parking it where they see guaranteed pricing power. The tension between expectation and reality is also playing out heavily in how people evaluate different brokerage ecosystems and trading tools. A retail trader using the Robinhood mobile app might look at a 5% move and try to trade options for a quick profit, whereas an institutional allocator using an interactive broker's account is looking at the forward price-to-sales multiple and calculating the multi-year return on capital. Right now, Microsoft trades at a forward price-to-sales ratio of just over 8 times, which is historically a premium compared to the broader software industry average of less than 7 times. But the reality is that Microsoft's underlying business carries an efficiency rating that few companies in human history have ever matched, which justifies that premium in the eyes of long-term wealth managers. Please comment below with your specific strategy for this tech giant. Are you actively accumulating more shares at these levels, or are you waiting for a deeper market pullback before deploying more capital? Let me know your thoughts down in the comment section. To fully understand why this business model is so resilient, we have to look at the structural foundation of what Microsoft actually does. At its core, the company operates a massive interconnected digital ecosystem centered around 3 major pillars: productivity software, cloud infrastructure, and personal computing. Their enterprise cloud platform, Azure, serves as the modern foundational architecture for corporate computing, data storage, and app development. By integrating their advanced intelligence models directly into the existing office workflows that billions of people already use every single day, they eliminated the friction of user acquisition. A company does not have to go out and buy a new software package. They simply check a box to upgrade their existing enterprise agreement. This historical dominance is what gives the company such an incredible moat. When retail investors look for investment help or browse popular investing sites, they often forget that switching away from Microsoft's core software is practically impossible for a Fortune 500 company. The costs, security risks, and retraining requirements involved in moving an entire global workforce off of their operating systems and database architectures are prohibitively high. This reality means their cash flows are remarkably sticky, even during broader economic downturns or periods of high inflation. While consumer-facing businesses suffer when household budgets tighten, enterprise IT spending on core infrastructure remains a non-negotiable line item. Looking backward at the older financial reports from earlier in the year, the business did face some normalization challenges. Growth in physical product revenues and traditional transactional office software slowed down to just about 1%, as the post-pandemic hardware buying cycles fully cooled off. Some divisions saw weaker renewals as customers transitioned away from legacy contracts. But the market overreacted to those softer numbers, dragging the stock down from its previous peaks and creating the exact valuation discount that smart capital just exploited. The institutional money realized that the legacy business slowdown was minor compared to the explosive acceleration occurring within the cloud divisions. Now, as we look toward the future, the investment narrative is shifting towards a set of specific catalysts and risks that will define the next phase of this market cycle. The biggest variable over the next 12 months is how effectively Microsoft can manage the massive capital expenditures required to build out its physical data centers. Running high-level corporate computing clusters requires an enormous amount of physical real estate, specialized microchips, and massive amounts of electrical power. If the costs of building these advanced facilities rise faster than the revenue generated by the usage-based software models, operating margins could face renewed pressure, causing another wave of volatility that will test the patience of retail portfolios on the SoFi trading platform. Furthermore, competition in the enterprise space is quietly intensifying. Alphabet has been aggressively bundling its own corporate digital tools into its workspace platforms, reporting significant sequential growth in active users for its own corporate solutions. For an investor using self-investing accounts, watching the market share split between these two tech giants will be critical. If Microsoft can maintain its current market share lead among corporate clients, its premium valuation will likely remain intact. However, if price competition forces them to lower their usage fees, the growth rate could moderate toward the mid-teens, which might disappoint growth-focused Fidelity wealth management accounts. There is also a fascinating macro trend to watch regarding how retail capital behaves in this environment. Platforms like Robinhood stock trading and SoFi investing have made it incredibly easy for regular people to buy fractional shares of high-priced tech stocks. This steady inflow of retail capital provides a consistent baseline of liquidity for mega-cap names. When a stock like Microsoft drops, it automatically triggers buy orders across millions of individual retirement accounts and automated intelligent portfolio systems.
This retail support floor, combined with massive institutional buying, creates a unique supply and demand dynamic, where downside risk is consistently mitigated by a wall of passive and active capital waiting to buy the dip. When you look at the landscape across different platforms, from interactive brokers trading to standard Fidelity IRAs, the central conclusion is that Microsoft's recent price action has fundamentally reset market expectations. The narrative that big tech had run out of immediate growth opportunities has been thoroughly debunked by the reality of realized corporate spending. The companies that are actually building the infrastructure and selling the software are proving that their revenue pipelines are robust, predictable, and highly profitable. In summary, the story of Microsoft right now is a classic example of market expectations falling out of sync with structural reality. The market spent months worrying about capital expenditure costs and cooling software demand, driving the stock down to its lowest multiples in years. The reality, delivered via hard financial data and massive institutional volume, proved that the underlying business model is accelerating rapidly as enterprise clients adopt usage-based computing models.